Okay, so I'm going to talk through the 10 accounting concepts. So these are concepts that help all accountants stick to similar themes. So the first one is business entity, and this one just means that the business financial accounts and the owner's financial account should be separate. So anything for the owner should be done via the drawings account. So if the owner pays for a holiday, that should be debited to the drawings account. It shouldn't be mixed in with the business accounts. There's some information that you can read. Materiality. This just means anything that's low in value can be grouped together in a sundries expense account. So for example, donations to charity, paying a window cleaner, stuff like that. Instead of having a window cleaner account, it's only going to be £5 a month, or perhaps. It's silly to have an account just for that. So we group all those small expenses together into one expense. Also, non-current assets such as a stapler, such as a calculator, non-current assets you would normally have a separate account and you would depreciate yearly. However, for low value non-current assets, we treat them as expenses and we don't bother about depreciating them. Cost. This one's an easy one. This one just means that when a transaction takes place, we value the transaction at the amount at the cost. So if I buy a vehicle for £20,000, I list £20,000 on my financial statements for the cost. Even after 5 years, I still list that £20,000 as the cost. I might have some depreciation to it. However, the cost is always listed as £20,000. The only time this one gets ignored is if we revalue a non-current asset, then the cost will change. Going concern. This just means we assume the business is going to continue trading for the foreseeable future. This just ensures that stuff like inventory and assets, they're valued at the correct price, because if the business was going to close down next year, you would value the asset to the lower price in order to sell them off. Accruals, which used to be called matchings, just means that expenses and income are matched to the year in which they're due. So, for example, if you make any prepayments or you owe money at the end of the year, then the prepayments goes to the next year and the bit you owe goes to this year. So what you should have paid in the year is what goes in the income statement, or what you should have received in the year goes in the income statement. What you actually paid is irrelevant. The bit you're missing on the bit that you paid extra, that gets dealt with on the statement of financial position as other receivables, other payables. Consistency. This just means the policies you apply should be the same every year. So depreciation, provision for doubtful debts, they should be the same percentages each year, the same methods. Realization. This just means that a transaction isn't put on our financial statements until ownership changes. So a promise of a sale isn't enough. It's when the sale actually takes place, whether that's cash or credit. As soon as an invoice or a receipt is made, that's when ownership changes and we record the sale. Now, goods on sale or return is a perfect example of that. So if I sell some goods to a company on goods or sale or return, they won't be classed as a sale until that business sells them on. So they'll still be classed as my inventory until I sell them on. Prudence. Prudence just means that we can't overstate profit or net assets. So that means we should always go for the conservative figure. Money measurement. Money measurement just means that we're only interested in anything that can be measured in money. So we don't really care about the quality of the goods or services we're making from an accountant's point of view. We don't look at how productive our staff is. All we care about as an accountant and for the financial statements is money. Duality, which again could be called dual aspect. This just means every transaction appears in two separate accounts, but the equal amount just on different sides of the account. So double entry bookkeeping is a prime example of that. We have debits and credits, equal and opposite. So the accounting equation should always be balanced. So my assets should always equal my capital and liabilities. And that's the 10 accounting concepts.